Have you ever stopped to think about all the financial things that happen every single day at a company the size of Disney?
Oh, absolutely. It's mind-boggling.
I mean, just think about it. Every park ticket purchased, every movie streamed on Disney, plus every Mickey ear hat sold.
Every single interaction on their website, every resort booking, it's a truly staggering volume of activity.
Yeah, and it's not just about the individual transactions, right? It's about how they all connect together to form the bigger financial picture of the company.
That's exactly right. And that's what we're going to kind of break down today.
We're doing a deep dive into the fundamentals of business transactions and how they're recorded.
We're going to explore how these individual financial happenings, these transactions, are identified, analyzed, recorded, and then summarized.
Because once you understand those basic building blocks, then those complex financial statements start to make a whole lot more sense.
Exactly. So ready to unravel this financial web?
Absolutely. Let's dive in. So first things first, what exactly is a business transaction? What are we even talking about here?
Well, in the simplest terms, a business transaction is any event that has a measurable financial impact on a business.
Measurable meaning we can put a dollar value on it.
Exactly. So when Disney sells a movie ticket or pays its employees, those are clear examples of transactions.
Because there's a direct financial consequence that we can easily quantify.
But, and this is important, not every event related to a business is a transaction.
Like, if I see a cool ad for a Disney cruise, that's not a transaction in itself.
Nope, that's just marketing trying to entice you to eventually lead to a transaction. The actual transaction happens when you book that cruise and there's an exchange of money.
Ah, so the key is an actual exchange of value taking place.
Yes, and every transaction has two sides to it. Something is given and something is received.
So when I buy that cruise, I give Disney money and they give me the cruise experience.
Precisely. And accounting meticulously tracks both sides of this exchange, which is where the fundamental accounting equation comes into play.
Oh yeah, that famous equation. Assets equals liabilities plus stockholders' equity.
It might seem simple, but it really underpins the entire financial accounting system.
Could you give us a quick refresher on what those terms actually mean?
Of course. Assets are what the company owns. Things like cash, inventory, buildings, anything that will provide future economic benefit.
Liabilities, on the other hand, are what the company owes to others.
Right, like loans, unpaid bills, those sorts of things. And stockholders' equity represents the owner's stake in the company, their claim on the assets after liabilities are deducted.
And to keep track of all the changes in these elements, businesses use something called an account, right?
Exactly. Think of an account as a dedicated record for tracking changes in a specific asset, liability, or equity element.
So, for example, Disney would have a cash account to keep track of all their cash inflows and outflows.
Absolutely. And they'd have separate accounts for all their other assets, like accounts receivable, which tracks money owed to them by customers.
Notes receivable, which are like formal IOUs with interest.
Inventory, which would be all their merchandise.
Prepaid expenses, things like insurance or rent paid in advance.
And then there's film and television costs, which is a unique asset for a company like Disney.
Ah, yeah, because their movies and shows are expected to generate revenue in the future.
Exactly. So those costs are initially recorded as an asset and then gradually expensed over time as those films and shows are released and generate revenue.
Then we have investments, which could be Disney's holdings in other companies.
And finally, parks, resorts, and other property, which represents all those massive physical assets like the theme parks themselves, the hotels, and the rides.
It's fascinating to see how many different types of assets a company like Disney has. Now, what about on the liabilities side?
Well, the most common one you'll see is accounts payable, which is basically the flip side of accounts receivable.
So it's the money Disney owes to its suppliers.
Exactly. Then there's notes payable, which are formal loans that Disney has taken out, backed by written promises to repay.
And then we have accrued liabilities, which are expenses that Disney has incurred but hasn't yet paid.
Right, like interest payable, salaries payable, those sorts of things. They're like debts waiting to be settled.
Okay. And then finally, we have stockholders' equity. You mentioned that this represents the owner's stake in the company.
That's right. And for a corporation like Disney, the main components of stockholders' equity are common stock, retained earnings, and dividends.
Common stock represents the initial investment made by shareholders when they purchase shares of Disney stock.
Retained earnings is the cumulative profit that Disney has earned over its lifetime, minus any losses and dividends paid out.
And dividends are those payments that Disney makes to its shareholders, distributing a portion of its profits.
Precisely. Now, before we move on, are you ready for a quick try it challenge?
Bring it on.
Can you name two things that would increase Disney stockholders' equity and two things that would decrease it?
Well, based on what we just discussed, I would say earning revenue would increase equity because it adds to their profits.
Excellent. That's one for increasing equity.
And I'm guessing paying dividends would decrease equity because that's money flowing out to the shareholders.
Spot on. You got both of the decreased equity ones right off the bat.
Okay, so one more for increase. I know that issuing new shares of stock would bring in more investment, so that would increase equity, right?
You got it. See? Understanding these concepts can really help you decipher the financial movements of a company.
Definitely. Now, so far we've mainly talked about recognizing transactions and the different types of accounts involved.
Right, but now we need to understand how these transactions actually affect the accounting equation in a practical sense.
And for that, the source material uses a case study, Alladin Travel, Inc.
This hypothetical travel agency will help us see how each transaction impacts specific accounts and keeps that accounting equation perfectly balanced.
Because remember, every transaction must either have an equal effect on both sides of the equation or cause offsetting changes on the same side, always maintaining that equilibrium.
It's like a seesaw. You can add weight to both sides equally, or you can shift weight around on one side to keep it balanced.
So let's walk through Alladin Travel's first 11 transactions and see how they affect the equation.
Okay, the first transaction is the initial investment by the owners. They put $50,000 cash into the business, and the company issues them common stock in return.
So cash, which is an asset, goes up by $50,000, and common stock, which is part of equity, also goes up by $50,000.
Exactly. The equation remains balanced because both sides increase by the same amount. Now, transaction 2. Alladin Travel buys land for $40,000 in cash.
So one asset, land, goes up by $40,000, but another asset, cash, goes down by $40,000.
Perfect. The composition of assets change, but the total value of assets remains the same, so the equation is still balanced.
Okay, transaction 3. Alladin buys $500 worth of office supplies on account. What does on account mean?
It means they receive the supplies but promise to pay for them later. So, supplies, an asset, goes up by $500, and accounts payable, a liability, also goes up by $500.
I see. Both sides of the equation increase, maintaining that balance. Transaction 4, Alladin earns $1,100 in cash for providing travel services.
This is where revenue comes in. Cash increases by $1,200, and retained earnings, a part of equity, also increases by $1,200, reflecting the earned revenue.
Makes sense. Transaction 5 is similar, but this time Alladin earns $3,500 in revenue on account.
Meaning they haven't received the cash yet. So instead of cash going up, accounts receivable, an asset representing the money owed to them, increases by $3,500.
And retained earnings still increases by $3,500 to reflect the revenue earned. Now, transaction 6 involves Alladin paying some expenses.
Yes, they pay $800 for rent, $900 for salaries, and $400 for utilities, all in cash.
So that's a total of $2,100 flowing out of the cash account, reducing assets.
And each expense also reduces retained earnings because expenses decrease the company's overall profit.
So both sides of the equation decrease in this case. Transaction 7 is Alladin paying $300 on account.
This is where they settle a portion of that accounts payable balance we talked about earlier. So cash goes down by $300, and accounts payable also goes down by $300.
Both sides decrease again, keeping things balanced. Now, transaction 8 gets a bit tricky, right? It involves the owner's personal finances.
Yes, this highlights the crucial entity assumption. The owner's personal home renovation, even though it's paid with their own money, doesn't affect the company's financial records.
We keep the business transactions separate from personal transactions. That makes sense. Transaction 9 is Alladin collecting $1,000 in cash from a customer who owed them money.
So cash goes up by $1,000, and accounts receivable goes down by $1,000, representing that payment received. Again, just a shift within the assets, keeping the total value the same.
Transaction 10 involves Alladin selling some land for $26,000 in cash, which was its original cost.
This is similar to buying land. Cash goes up by $26,000, and the land account goes down by $26,000, balancing the equation.
And finally, transaction 11 is Alladin declaring and paying a $700 cash dividend to its stockholders.
This one decreases cash by $700 because money is going out to the owners, and it also decreases retained earnings by $700 because dividends are a distribution of profit.
So there we have it, 11 transactions, each impacting the accounting equation in a specific way, but always keeping it balanced.
And this meticulous tracking of each transaction ultimately provides the data needed to create the company's financial statements.
Like the income statement, which shows revenues and expenses, and the balance sheet, which gives a snapshot of assets, liabilities, and equity at a specific point in time.
Exactly. Now, up to this point, we've focused on the big picture impact on the accounting equation. But to truly understand how these transactions are recorded, we need to dive into the world of debits and credits.
Yeah, this is where things can get a little confusing for some folks.
I get it. The terms themselves can be a bit abstract, but don't worry, the underlying concept is pretty straightforward.
So what exactly are debits and credits?
Well, first off, it's crucial to remember that every transaction affects at least two accounts. You can't have money magically appearing in one account without it coming from somewhere else, or vice versa.
Okay, so this double entry system ensures that we're always recording both sides of the story.
Precisely. And that's where debits and credits come in. They're simply a way of indicating which side of an account is affected by a transaction.
And the source material uses those handy T accounts to illustrate this.
Yes, the T account is a visual representation of an account, with debit on the left side and credit on the right.
And here's the key thing to remember. It's not that debits are good and credits are bad, or vice versa.
It simply means left side and right side. Whether a debit or credit increases or decreases an account depends on the type of account we're dealing with.
So for asset accounts, a debit increases the balance and a credit decreases it.
Right. But for liabilities and stockholders' equity, it's the opposite. A credit increases the balance and a debit decreases it.
It's almost like a mirror image between assets and the other two.
Exactly. Let's go back to Alladin Travel's first transaction. They received cash and issued common stock.
So cash, an asset, increased, which means we would debit the cash account.
And common stock, part of equity, also increased, so we would credit the common stock account.
Debit on the left, credit on the right for every transaction, always maintaining that balance.
Now, revenue and expense accounts can be a bit trickier to grasp.
Yeah, how do they fit into this debit and credit system?
Well, remember that revenues increase stockholders' equity, while expenses decrease it.
So logically, we would credit revenue accounts to increase them and debit expense accounts to increase them.
Precisely. However, there are a couple of important exceptions to keep in mind.
The source material mentioned dividends and the expense accounts themselves as exceptions.
Yes, even though dividends and expenses ultimately reduce stockholders' equity, they are actually increased with debits.
So it's almost like they have a contra effect on equity.
That's a good way to think about it. Now, we know how debits and credits work, but how do we actually record these transactions systematically?
That's where the journal comes in, right?
Exactly. The journal, also called the Book of Original Entry, is where all transactions are initially recorded in chronological order.
So it's like a diary of the company's financial activities.
And the process of recording a transaction in the journal is called journalizing.
And there are three main steps involved. First, you identify the accounts affected by the transaction.
Second, you determine whether each account increases or decreases and apply the appropriate debit or credit rule.
And third, you actually write the entry in the journal, with debits on the left and credits indented on the right.
The source material even gives an example of Alladin Travel's first transaction, showing how it would be journalized.
Now, the journal provides a chronological record, but what if we want to see all the activity within a single account?
That's where the ledger comes in. It's essentially a collection of all the individual T accounts for a company.
So if we want to see all the changes in the cash account, we would look at the cash account in the ledger.
And the process of transferring the amounts from the journal entries to the ledger accounts is called posting.
So we take the debit and credit amounts from the journal and post them as debits and credits in the corresponding ledger accounts.
The source material visually shows this flow of information, from transaction to journal to ledger, using Alladin Travel as an example.
Okay, so after all the transactions are journalized and posted, how do we make sure everything is still in balance?
That's where the trial balance comes in. It's simply a list of all accounts with their balances to check that debits equal credits.
So it's like a final check to make sure we haven't made any mistakes along the way.
And if the trial balance of balances, it gives us confidence that our accounting records are accurate.
The source also mentioned that the trial balance can be useful for analyzing accounts and spotting errors.
Right. By looking at the changes in account balances, we can often figure out missing information or identify mistakes.
Like, if the difference between total debits and total credits is divisible by 2, it might mean a debit was entered as a credit, or vice versa.
Now, finally, the source introduced the chart of accounts and the concept of an account's normal balance.
The chart of accounts is basically a list of all the accounts a company uses, each with its own unique number.
It's like a catalog of all the different financial elements the company tracks. And the normal balance of an account simply tells us which side, debit or credit, typically increases that account.
So for assets, the normal balance is a debit, and for liabilities and equity, it's a credit.
Exactly. But remember those exceptions. Dividends and expenses are increased with debits, even though they ultimately reduce equity.
So to wrap up this incredible deep dive, we started by defining a business transaction and explored the different types of accounts.
We then saw how these transactions impact the accounting equation using the Alladin Travel case study.
We learned about debits and credits and how they're used to record transactions in the journal and ledger.
And we discussed the importance of the trial balance for ensuring accuracy and the usefulness of the chart of accounts.
It's truly amazing to see how these seemingly basic concepts form the backbone of the entire accounting system.
And by understanding these fundamentals, you'll be able to decipher financial information with much more confidence.
So here's something for you to ponder. Now that you know how individual transactions are recorded, how does this change your perspective on a company's financial health?
What new questions come to mind when you read financial news or analyze a company's performance?
And if this deep dive has left you wanting more, join us next time as we explore the next steps in the accounting cycle.
We'll delve into the adjustments that are made to account balances before those final financial statements are prepared.
Until then, happy accounting.